Who's this? Oh, you're an entrepreneur? Oh, you're a real estate investor. Oh, you're trying to learn from those who did it. Well, come into the lab then. Put your white coat on, gloves on, notepad, and let's build, y'all. Real estate experiment. What is happening, y'all? Today we have Matthew Sullivan dialing from Utah, and I'm super stoked to have you in the lab. Like I said, my team does such a good job of finding experimenters, and you're a true embodiment of what Experiment Nation is all about. You didn't even know that though, but here it is, and the reason why is just looking at your body of work. I'm so excited to find out which one comes first or which one came first and what the foundation was about. And I truly believe that your reflection of your business is a reflection of who you are. But just to level set, if you're just tuning in, depending on where you're listening to this, you are the CEO and founder of Quantum Real Estate. Am I correct?
That's correct. Absolutely. Yes.
Also president of a crowdfunding company, crowdventure.com. You're an author of Head First, a roadmap from entrepreneurs, Hooked on Startup podcast host. The list goes on. You worked with Richard Branson on the corporate financing team in London. I saw that. And you were appointed director and trustee of Virgin's London Air Ambulance, which is super interesting. I want to tap in that for a little bit because we have so much to cover today on the real estate side. But nonetheless, you're a serial entrepreneur. You've built companies. You've found ways to leverage cash and understanding equity. There's so much that I want to unravel. But before we get into that, let's talk about who is Matthew Sullivan and who he is. Who was Matthew Sullivan before and who is Matthew Sullivan today? How do you the trajectory and a condensed, compact overview of what you've been able to accomplish? Talk to us a little bit about your background, Matt.
Well, I think Ruben, thank you for having me on the show.
Absolutely.
But I think my background is really just a function of being just systemically unemployable. I discovered at a very early age that I was completely unable to hold down a proper job. So the only path open to me was that of an entrepreneur. But I think I was in my sort of early 20s. I had this sort of feeling that I really just did not want to work for anyone because I think I should have written a book then because I had all of the answers and knew everything at the age of 21. But when I think I started off life as a stockbroker in the late 80s. And you just feel like there's so much out there. You just want to do some of the things. We were visiting lots of companies across the Far East. And I think then I sort of really decided that I wanted to be one of those guys that was doing those really interesting things and not just sitting on the sidelines reporting on it. So, I've had a great, set of businesses that I've worked with, and I was involved with the internet when it was just a young child, and watched it grow into the sort of where it is today. Back in sort of the late 90s, I've been involved with cryptocurrencies at the very beginning, and not quite the very beginning, but I've been involved in all sorts of different things. From telecommunications to finance to, right now to real estate. So it's been a very interesting journey across, multiple different, businesses. I'm sorry if I'm stumbling here, but my 1-year-old daughter is busy trying to break into my office.
Oh well,
so I've got one eye trying to super how far she's going to get.
Super welcome. First of all, there's no stress at all. We have a great team here. If we need to cut anything out, we will, but we won't because we love it raw.
Well, no, that's fine.
Family
it's
Guy
like that BBC thing where the guy's distracted because his entire family is sort of marching in.
No, that's. Trust me, completely welcome. So if you're listening to this right now, I haven't seen the daughter
she's
yet.
Gone now. She's gone to wreak havoc somewhere else.
She's super welcome to tune in because I'd love to hear. Maybe she can give us more insight, right? Exactly on the behind the scenes. All right, cool. So, in other words, what I find very interesting, and we're going to get to, I think, what will serve our listeners because our listener base is based on entrepreneurs and real estate investors, and obviously we'll talk about quantum real estate. But what I'm curious about is, we hear this thing about focus. We hear this thing about, opportunities. There's so many right now. I mean, even myself, I'm coming across them, but I got to stay laser focused. As an entrepreneur, a serial entrepreneur like yourself, who has It sounds like obviously you've built operations in a lot of different pools. What does it look like, that foundation? Can you build? I want to hear it, because I hear one thing, and there's different methods out there. There's different people with different beliefs. Do you build one strong pillar first, or do you experiment broadly, get a sense to see what you're interested in? Like, what did that look like for you? Because you talk crypto, you talk real estate, there's just so many things. And I know you're a very seasoned entrepreneur, but maybe take us back in the beginning. What did that look like when you were tackling opportunities, and what maybe did you learn from that? And what would you advise someone tackling new opportunities now?
Well, I mean, working backwards, the advice is stay laser focused. The worst thing is to be to try and run lots of different projects. And what tends to happen, what happened with me, is you fall into something. So you know that you want to do things, you want to be creative, you want to run your own business, unless you've got some absolutely clear calling as to what you want to do. What tends to happen is you'll fall into something. But okay, fast forward, what I've learned is you've got to become good at something. Now, it doesn't matter the fact that you're beginning or starting this business yourself. The same rules apply. In fact, it's even harder to a certain extent. Do not become distracted. I mean, you have to pivot and change and go with the flow to continue the growth of your business. But the most destructive thing is to become distracted and try to be all things to all people. I mean, what we've done, in the last 3 years, I dedicate every living moment of my life to this one thing that we do at Quantum, which is to unlock people's equity without taking on more debt. Nothing else. There's no room in my head for anything else. So you have to have that combination of focus, determination, and persistence, because the only thing that makes things work, unless you are incredibly lucky, is persistence. Is that sort of determination to drive your idea through.
I'm so glad you said that, because I think, when we'll get into the real estate, but the real estate umbrella, the question is, hey, what kind of real estate to a new should I get into? And it's like, well, there's a large umbrella, right? And the way I typically, and I could be wrong, so I want to hear your insight on this, is, first of all, you need to get exposure to what's out there, right? So what exists, awareness, planting the seed. And then once you've identified, an opportunity that resonates with you, makes sense, or where you feel maybe competent in, or where you want to actually obviously build the sweat equity and build the, the commitment, then you double down on that. And I know that, and I'm curious to see if that's how you would look at it, as maybe just a very kind of siloed kind of, situation to someone who say, hey, what kind of real estate do I want to get into? And would that be a very similar approach to how you built your multiple businesses? Or
yes. And again, you got to remember that all these businesses I'm talking about, go back over a 30-year period. So even though it sounds like a lot of different things, some of these businesses are around for 5, 6, 7 years. And, so they weren't businesses that I simply hopped from one to the other. The thing with real estate is, if you want to be involved in real estate, you're either involved in a passive way or in an active way. If you are a passive investor or participant in real estate, then there's a whole different set of things you need to look for. You need to look for how good are the people that are going to manage your money. So you can park that to one side, because there's an enormous amount of research that you can go through. And that really is about doing research to find the people that are able to manage real estate portfolios and manage transactions and manage money in the real estate, in the side of real estate that interests you. You might be interested in commercial or residential. Now, if you want to be an active investor, you have to treat it like a job. So if you want to be a successful active investor, you have to come with an active investor's mindset. So that means that you cannot expect that magical things will happen by investing in real estate just because it's real estate. So all of the things that you would normally do with any other job that you were actively involved in terms of doing the research and of where you should spend your money and why you should spend it and what happens if it goes wrong, putting business plans together, putting scenarios together, all of those things you have to do if you want to be a successful real estate investor. And then what happens is I can't remember what the expression is, but it's something like, no business plan survives first contact with a customer. In other words, no plan survives first contact with the enemy. So it's the same sort of idea. No matter what you think is going to happen, the moment you start actively investing, something else is likely to happen. So you have to be prepared to pivot, to be flexible, to see what happens if those scenarios happen, to take place. So my advice to anyone, real estate is an enormous, incredibly exciting, very fulfilling, and can be very profitable, but you have to be completely dedicated. And what tends to sharpen your mind more than anything is by investing your own money. So the other thing I would say is start small, but get the shovel dirty, make an investment, get involved. If you stay on the sidelines too long, then you won't have the benefit of that direct experience of being in with your money, and that takes it to a completely different place if you actually make investments.
So Matthew, that's a great segue, because now we're at the stage we're listening to you and I hear you. Okay, let's say I'm an investor, I hear you loud and clear. I'm active, I want to be in the game, pedal to the metal. I have an investment property or several. Now, some of what we talk about, or maybe we don't talk about it often, is we talk about, what's the ROI? What's the ROI, right? Return on investment. But, often we don't always talk about the return on equity. And I want to tap into that a little bit, because I know that this is something you specialize in when you talk about the ability to leverage. And so I want to talk about, as an investor, you having money parked into an investment. There's that cash on cash. There's several things that depend on your investing strategy you're looking at. But evidently what happens in real estate, sometimes you're building equity that often isn't really leveraged or tapped into, or it's tapped into in a very traditional way. Can you just blow us out of the water here? Like, I know you have a model in quantum real estate that you talk about that's, tapping into equity, right? Talk to us about the biggest opportunities you feel that the traditional investor kind of overlooks when it comes to the equity that lives in the actual assets that they actually own.
Well, it's really, equity is a very large asset class. So the equity in single family homes or in residential homes in the United States is around, between 15 and 17 trillion. So that is the amount of ownership that people have in properties that is not financed, and the amount of mortgage is quite similar. So there's over 15 million homes where the owner has 50% or more equity. So what we do, and this is sort of answering your question, but we help homeowners, whether you are owner occupiers or whether you own investment properties, we help you access some of the equity in your property without going deeper into debt, without borrowing money. Now, the problem that solves is that if you are a homeowner and you've built up equity, the only way right now that you can access that value is to go to the bank and borrow money by way of a mortgage or a cash out refinance or a home equity line of credit, or in some cases a reverse mortgage. All of those are debt products. All of those increase the leverage on your property, and you're in most cases increasing your monthly outgoings because you have to service that debt. Our home equity agreements enable homeowners to access that equity by way of an equity-based instrument. So what that is, we have investors who want to participate in the potential house price appreciation. So they get paid. Their ROI is a return on their investment by sharing in the potential increase in value of the home rather than charging you interest. So they get paid differently. They don't lend you money. They participate by way of a home equity agreement in the potential appreciation of the home. Now, what that means is the homeowner gets a cash lump sum that is not a loan, so it's not counted towards debt to income. It's not counted towards their credit score. It's free cash without capital gains or income tax immediate implications, and it enables them to do whatever they want with it. So our instruments allow people to take equity in their homes, use it as a way to invest in other properties or pay down expensive debt, or a number of other different ways.
So leverage on leverage. So I want to take a step back because I think you're hitting some such key points, and I want to make sure our listeners are also following, so we can actually compare either apples to apples or oranges to, right, whatever it is. So let's take a step back based on what we're used to, because I think one of the biggest things that I'm passionate about is there's no secrets out there, or I don't know, wouldn't say that there's secrets out there. It's just knowledge, right? And awareness. So what I want to do is plant the seeds and give actionable steps. But for that, we got to understand and speak the same language. So let's talk about the differences between a reverse mortgage, HELOC, and those, so we can kind of set them aside and see what the benefits and advantages are, so we can understand, and then we can kind of jump into this new form that you're introducing to us and the listeners. So if I'm listening, I'm a HELOC, I may have heard of it. Can you help us explain to us what it is and maybe what some of the benefits or pros and cons are? Because I heard you say a key thing, debt to service debt ratio, which is very important. So let's talk about that for a second.
Sure. Well, a HELOC is a banking product, is a debt product. So it's a loan. Stands for, HELOC is home equity line of credit. So in other words, the bank says, okay, you've got a certain amount of equity in your home. So there's my security. You've got income. So if you are going to borrow some money from me, I know that you've got enough income to be able to service the debt. In other words, you've got enough spare cash to make those monthly payments. So what I'm going to do is say, I'm going to give you a home equity line of credit, which means you can borrow up to, let's say, $50,000. It's secured against your property. You don't have to borrow the money now, but it's there if you want it for the next 10 years. So it's a bit like a big credit card where you can go out and you can spend the money when you want up to that $50,000 limit. And that debt is secured against the home. And for the first 10 years or so, I'm not going to ask for you to repay the loan. I'm just going to charge you interest. But then after that 10-year period, it's going to reset and it's going to turn into a normal loan. So if you have used some of that line of credit, then you're going to have to start paying off that capital sum.
Well explained, very well explained. What about now? Let's put side by side reverse mortgage, because that's one thing that doesn't come up often in our world.
Well, yeah, and again, a reverse mortgage is only available to certain people. So you've got to be over 62 to start with, and it's quite restrictive. So it's a mortgage, but in reverse, as you would imagine. So rather than making monthly payments and reducing the balance, what happens is all of the interest is added to the balance, and you make one big payment at the end of the term. So what happens is, if you borrow some money, you get your capital sum. So that's the money that the bank gives you. And then every month, the interest is added. So it's a reverse amortizing mortgage. So rather than the capital principal sum reducing every month, it actually increases because you're adding the interest to it. And the bank is saying, well, okay, you've got enough equity in your home. So if your house grows by a certain percentage, then by the time we think you're going to close this out, and it's normally when you move or if you pass, for example, then by then there will be enough equity in your home to cover the amount of mortgage. So, you'll probably have to sell your home then, but there'll be a little bit of equity left for you. Probably most of the equity will go to us. And so reverse mortgage is a way for people who don't have income, because as I said, it's a product that is really aimed at seniors. It enables you to leverage, literally borrow money against your home, but not make any payments. The trouble is they're quite expensive. The interest rates are not terribly competitive, all sorts of charges added, and they're quite restrictive. For example, if the last remaining qualifying person moves out or is no longer there, then the mortgage has to be paid off. So you can't pass this to people that inherit your house. The mortgage has to be paid off. So it can be a bit of a rude awakening at that point.
Excellent. So it sounds like we got HELOC, we got reverse mortgages. Is there any other one that comes to mind? Because I want to make sure.
Well, these are the things that a home equity agreement is not. by the
Yeah,
way, just to remind
exactly.
everything.
Yeah.
So it's not a reverse mortgage. It's not a home
Yeah.
equity line, and it's not a mortgage. So the other way that people access their equity is just to increase their mortgage. So they may have taken out a mortgage when they bought their home. The mortgage has gone down a little bit because they've paid off some of the principal. The house has gone up in value over time because it's appreciated. So the equity that they have in their home is now increased. So they can go back to the bank. And as long as they've got the right credit score and the right earnings capability and the qualifying debt to income ratios, they can probably borrow some more money. I say probably because it's becoming even more difficult, more and more difficult, particularly in a post-COVID or a during COVID world, because banks are looking for higher credit scores and lower debt to income ratios.
Absolutely. And I'm glad you brought that up, Matthew, because that is a reality that, the refinancing I was just at an all-time high during these phases, and now they're coming in with, different, whether it's Fannie Mae or Freddie Mac, they're coming in with their new regulations and procedures that they want you to jump through in order to tap into maybe some of that income. So I think this conversation is very prevalent and appropriate with during these times. As we're recording this right now, it's February 8th, 2021. So I do appreciate you highlighting that. You were going to add something.
Yeah, I was just going to say that, but all of these debt products, obviously they're debt products, but that means that if you miss payments, then you run the risk of losing your home. So as most of the people that we speak to either cannot borrow money or don't want to borrow money, because if you've spent your entire working life paying down your mortgage, then you don't want to be in a position where you've got that fear that if, for example, you cannot make these additional monthly payments, that the bank are going to take the house off you. And that's a real fear, particularly in an economic environment where there's so much uncertainty. So the problem with debt, it's relatively cheap money, but it comes with, you have to pay the piper every month. Or in the case of a reverse mortgage, there's no recourse to you as a person, but you could say goodbye to all of that equity. So there's a real difference between debt-based financing and equity-based financing. And equity is the other side of the balance sheet. It's the bit that you own. And as I said, we have investors that are interested in that piece, in buying into that equity, buying into that ownership, and growing their investment with you as your property increases in value. So they don't want interest. They don't want, debt servicing or the things that are traditionally associated with loans.
Yeah, that's very unique. And if you're, watching this, you can see I'm taking notes in here because I wouldn't really angle this how I go into this next segment, because this is interesting. So I think it was important for us to understand what debt financing looked like, right? Which I think is what most, folks who are, again, not aware are familiar with. These are the terms that people hear: refinancing, HELOC, etc. Now we talk about equity-based financing, and you said with you, and that's a very key word that I want to understand, because I believe that people can't do business with you if they don't understand how you do business. And now we understand what the win-win is. I think we understand it. Maybe some of the listeners at a hard money level understand what the win-win is, etc. But in your case, this is a new concept. I want to outline, why is it beneficial for a company like you or other investors, because you mentioned those others who are investing in that pool. Help us outline the difference, why it's beneficial for them, and it's also beneficial for you, the listener, who might be thinking of getting some equity-based financing. Help us map out that win-win situation so we bring it together a little bit.
Well, that's really important, and I'm very glad you asked that, because the first sort of reaction that we get is, this is too good to be true, because you're going to give me a lump sum and I haven't got to make any monthly payments. That means that you're giving me the money for nothing. No, it's not, because the first part of it is the case. Yes, we are going to give you a lump sum, but it's an investment. Now, the question is, what are we going to get in exchange for that? Well, you're going to sign an agreement with us or with one of our investor partners. And that investment agreement says it's an option agreement. So we're not going to be on title as owners or co-owners of your property. That's quite important. It simply says, when you sell your property, you will give us back the amount that we originally invested, together with a share of the increase in value. Now, we're not just going to get our normal share, we're going to get a little bit more. So if we invested in 10% of the value of your home, we're not going to get 10% of the increase. We're going to get a bit more than that. We're going to get maybe 20 or 30 or 40%, depending on underwriting. So we're going to get a magnified share of the return of the investment. So if your property goes up in value, we're going to take a bigger share than you are of that appreciation. And so that gives us a return. The difference is, because it's a return on an investment based on you selling your home, we're not going to charge you interest because we don't know how much that's going to be. So we will settle up with you when you sell your home or when you decide to refinance.
Oh, that's
So
very interesting.
That's why we don't need or cannot ask for monthly payments, because that would make it a loan.
Yeah.
So it's not a loan, it's an investment. We only know the amount that we're going to get paid when you sell your home. You could sell it for a lot less if the markets collapse like they did in 08, 07, 08. We run the risk that we could get back less than we actually paid you, because the amount we get is entirely dependent on the value of the home.
I love how you said, Matthew, how we run the risk, because that's what an investor does, and they're investing in the upside, ideally. In the worst case scenario, well, obviously you're kind of taking on that risk. So it does sound like a win-win, which is so great. Very fascinating, because and this is why you're here in the lab to give us that insight, because I'm like, oh, that's brand new. So let's talk about, now that we understand, we've level set, we understand the difference, and people's eyes are perked up now. Let's talk about the practicality of it. And I like to, maybe kind of go to an example, because I want to talk about like that, how that contract looks like. There's someone who's listening and might be thinking, like, I'm wondering if I can use this for like a fix and flip, or maybe, what kind of, let's just make sure we're clear. What kind of property are we looking at? Retail, is there, is it retail? Is it as in the home has to be livable? Some investors are listening right now that might be thinking, hey, maybe I can get cash up front for a home that's not habitable, but the money's going to go into it. Like, you probably know where I'm going with this. What kind of homes or properties, I should say, or investment properties, and then it sounds like maybe it's not even just tied down to real estate. It sounds like it's almost like a note. So let's just get that clarity out first.
Yeah, it's not. So it's not a note. So it's not a note in the traditional sense. So it's not a it's not a loan product.
Yeah.
We operate in 19 states. So the big states, California, all the coastal states, and we work with single family owner occupied and non-owner occupied properties, so investment properties, single family residences, multifamily units up to 4 units, and condos. We don't work with prefabricated or manufactured homes, and we don't work with land development. There has to be a dwelling, an inhabited dwelling on the property. Typically, the minimum size in terms of value is about 200,000, and the maximum size is about 5 million. And the reason for that is, over that figure, it becomes a little bit of a little bit less scientific in terms of figuring out the valuation. So that's our typically our sweet spot is homes around $500,000, $600,000, $700,000. That's where most of our business seems to fall. You can use the money for anything you like. There's no income tax or capital gains tax liability. That's all deferred until you sell the property. There's no early payment penalties, so you can use this as bridging finance. In fact, you can use this, there's a return cap that the investors have with some of the products that we work with, so that in the first 2 years, if you were to sell your property and pay off the home equity agreement, then the amount the investors can get is actually capped. So even if your property were to significantly appreciate, their return would be fixed and could not be above a certain amount. These agreements work in different durations. So you can have 10-year agreements, which means you have no payments for 10 years. And at the end of that 10-year period, the agreement becomes, or the obligation becomes, payable. And you also have 30-year agreements where, again, you have full use of that money, and you don't have to settle or buy back the agreement for 30 years.
Very interesting. So tactically speaking, now we're ready to take action. We're taking in all the info, and what I wrote down is this. Let's keep it simple. Let's say we're buying $100,000 home, but I want to understand at what point is it buying or has to be already pre-owned?
It has to be owned, so you have to own it. We're not but you can have just bought it. So in other words, you can buy the house on Friday and you can take out a home equity agreement the following Monday.
Okay, so what does that look like for? And I'm sorry, go ahead, Matthew.
I was going to say, so let's if we say $1 million home, because the minimum value is about a couple of $100,000.
Yeah, sure.
So if you've got $1 million home and you wanted to unlock, let's say $100,000, that's 10% of the current value of the home. So we would say multiply that figure by 3. Again, on average, these are just examples. So that would be 30%. So when you sell your home, which can be any time in the next 30 years, we will get back our original $100,000 investment together with 30% of the appreciation from the day that we took out the agreement to the day that you settled it. Now, you can settle it by selling your house. If you settle it by selling and it's a bona fide third-party arm's length transaction, in other words, you're not selling it at a discount to your brother-in-law, then we will take that value as the value of the property. If you decide to buy out the agreement, we'll send an appraiser out, an independent appraiser, and they'll fix the value. We'll agree on that. Now, from an investor's perspective, if your house does not go up in value, then we're going, hang on a minute, we've just given you that $100,000 and we're not going to make any return. So in order to build in some upside, should that happen, we will discount the value of your property when we start the agreement. So even though your property is worth $1 million, what we will do is we'll apply a discount to that and we'll start the clock running at a slightly lower figure, so that even if you sell your home for the same price or even a little bit less, then we'll still build in a little bit of a cushion. And that discount really depends on things like how much equity you have, where the property is, what your credit score is. There's a minimum credit score of 550. So we can't work with people below that, but that's quite a low figure. So, and the more equity you have, the more flexible we can be in terms of the amount of equity that we unlock, and the amount of debt to income ratios that we look at.
Oh, that's genius. So this is fascinating. I mean, it's the typical avatar that you're working with. Who would you say that is, and what would you, just to give people some insights, because we hear the model, but now putting into context. I know you've talked about it in the background a little bit of what you can do, but what are some things that someone who's listening to this can do with that kind of money, and why would they even consider kind of tapping in? I know it may seem obvious to us, but I want to make sure we get that message across.
Well, it's really, I mean, the customers that we work with fall into 3 main categories. So there's the people that cannot borrow money, those people that don't want to borrow money, and then people that see equity in their home as an investment and they want to diversify out of that. So those are the 3 sort of mindsets. Use cases, predominantly at the moment, it's people that want to pay off expensive credit card debt or other types of bills. And I think that's really because of what's happened with the economy over the last year or so. So I would say probably about 70% of the people that we work with just want to get their hands on some cash, just to sort of shore up their cash position, pay off those credit cards and have some kind of fallback position. Because remember, it's your money. We're just buying it off you at a discount effectively. Yeah. And so, you can put that in your bank account and leave it there, and you don't have to make monthly payments. So what some people do is once they paid off their credit cards, they'll invest that. They'll invest it in maybe bonds or stocks or instruments that are liquid that give them cash flow. Mm-hmm. So they're turning their equity into cash flow. We have people that in California in particular use the money to fund ADUs, which is, the granny flat, which you can put in your yard. So you can turn your backyard into something that generates rental income. and again, really popular in Los Angeles and other main cities where there's a real housing shortage. We have people that use it for business, funding new businesses, and just generally diversifying or using it to buy other properties, because it's not debt, you can use it as a down payment on another property.
That's where you got my attention there, Matthew. And I'm glad you said that, because it's a great segue, because we're in a space of leveraging. But I want to make sure that we bring this model home, because the part that I'm hung up on, and make sure that also our listeners who are probably going to be like, thank you, Ruben, for asking. Let's talk about the part where we said, let's say this is a 10-year contract, let's call it.
Yes.
10-year contract, 10% of $1 million home was able to tap into the 100K, or receive the 100K, let's say, right?
Yeah.
Is that the way to say it? At the end of that 10-year, am I forced to, man, I really like this asset. I really like what I was able to do, but we talked about it. It's time. The contract is due. Do I have to sell it? Or you mentioned something about refinancing
you have
earlier.
To settle the agreement. So the
so how do I,
obligation is,
give me my options of settling that agreement. So
you can sell the asset. So you can say, okay, I'm going to sell the home, and then whatever, when I sell the home, then but it doesn't have to be on that particular day. I mean, most people will buy the agreement back, and that means that you can borrow money, because imagine if you're in a situation where you can't borrow money because your credit score is shot, you're in forbearance, something's happened to your job, you're in that sort of catch-22 situation where 2 years ago you might have had an 850 credit score. That happens. If we can use this money to get you current and get you comfortable and repair your credit score, you can then go back to the bank and say, hey, my credit score is now 750. I've got my income back, or I can pay down some of my mortgage. You can then use debt to buy back your home equity agreement. So you can have an inheritance, you can have a windfall, you can have another property. The amount that is settled remains the same no matter how you settle it. So the calculation is the same. We don't mind how you settle it, whether you sell your home or whether you settle it with cash.
Yeah. The key part that you said, Matthew, that I love is like, this model can help you make you bankable again. Like,
absolutely,
because that's fascinating.
Debt.
Yeah.
Because you see, you're not robbing Peter to pay Paul. What you're doing is you're saying, okay, I'm taking money from my equity account, which is, real wealth that I own, and I'm going to use that to pay off some of this debt. Now that reduces your debt to income ratio. It does not simply move it from one debt to another. It does not appear on your credit report as debt. And that's very important, because you can use that to repair, a fairly serious, credit challenge that you may have if you have enough equity.
I can't thank you enough for going into depth about that. No, that's serious, because we've got to unfold these things, and it's probably gonna, the beauty of these podcasts is, guess what, guys, you can replay and play it back. And I certainly will myself, because this is new concept of again, I would call it creative financing. Maybe did I say something wrong? If you guys are listening, Matthew's lit up here. I want to make sure I'm saying the right thing.
No, you are. It's absolutely right. The good news is that we didn't invent it. So it's been around for about 10 years. There are a number of companies. We work with all of them. Every year more and more people are becoming aware of this. And it is creative, but the other good news is it's used every day in the commercial finance world. Equity-based funding is just another tool in the funding tool set for a commercial developer. You have all sorts of flavors of debt, mezzanine and senior debt and junior debt and preferred equity. We have shared appreciation mortgages. So there's all sorts of flavors of equity funding as well. We're just simply taking tried and tested funding mechanisms that work in the commercial world, and we're applying them to the residential market. And so it's not magic. It's been around, and that's really good news, because from a consumer or a homeowner's perspective, you need the confidence that, this is actually quite a straightforward proposition.
Yeah, and I'm so glad you said that. And we see this a lot. And I think part of financial literacy, or just really understanding business models, they've all been done at a very high level, right? Whether we're talking about the small syndicator versus like Blackstone, or vertical integration created in companies versus notes, bonds. Like, I mean, it's interesting because I think if you watch again, this is why we have a gentleman like Matthew come in here and tell us his proof of concept. The idea is, as a listener, it's all been out there, done before. It's a matter of
Yes.
how can I apply it in my world, at my level. And I think that's very important that you say that we're not reinventing the wheel here. When I
It is
say,
new. I mean, from a homeowner's perspective,
Mhm.
it's a relatively new financial tool, and
Yeah.
that's one of our challenges. Really, is the education, just explaining to people, like you said at the very beginning. Hang on a second, what's in it for you guys? I get to see what's in it for me. I can't quite figure that bit out. Once you realize what the balance is, how we make money, how you make money, that's an important educational hurdle.
Yeah.
Everyone understands what a mortgage is. Most people understand what a home equity line of credit is. When they were first launched, reverse mortgages and HELOCs, they had that same uphill struggle trying to explain to people how all the numbers work. So as we get more and more people using home equity lines of, here we go. Yeah, as we get more and more people using home equity agreements, and then it will become a mainstream financial product. And I will bet, my my favorite pair of sunglasses, and I'm very attached to them, I can tell you, that in 3 or 4 years this will become a major banking product. Then it will become much more mainstream, and it will be great because it will help millions of people who otherwise wouldn't have been able to borrow money.
Yeah, no, I mean, it's so interesting because you start finding out a lot more of these things. And again, I don't think you have to worry about our audience, because literally the real estate experiment is just that. It's experimenting with even whether it's new concepts in your world, as we like to call it, in our labs,
Yes.
that have existed for quite some time, that are quite new to you. So we're definitely open-minded, and as everyone should be, because if you've done what you've always done, you'll get what you always got. So I think that's very important that we highlight these differences. I want to touch on one last thing. I think it's important, like you said. I think I said this before. I think the level of transparency. I mean, I have an agency, I have businesses. When you work with a client, it's really important that you make it clear to them of literally like transparency of, hey, this is how we make money. We're not a charity here, but this is how you can benefit as well, right? And you mentioned again, your background is crowdfunding. I mean, we could have had different podcasts for so many different verticals that you have. So I'm kind of curious, when you say the investors, this is out of pure curiosity. And guys, we know we love business concept and business models. I just think it's so interesting. Is it like who are is it accredited investors or
At the moment, it's primarily at the moment it's primarily long-term capital sources. So it's institutions, hedge funds, endowment funds, people that have a capital allocation where long-term returns that are asset-backed fulfills that investment thesis or that investment requirement. So typically, we don't see that many accredited investors. However, we're moving towards creating mechanisms to make it easier for smaller investors to participate in what I think is a really exciting asset class.
Absolutely, because I was thinking about, just based on what you're telling me, it's and correct me if I'm wrong, but you talked about in the beginning, we talked about active versus passive investing. As we know, syndications, there's GPs and there's LPs. And if you told me, hey, we're gonna, and maybe this is it, right? Hey, we're gonna actually do equity based, and I want to make sure I'm saying these home equity agreements. Home equity agreements. There you go, branded home equity agreements. We're gonna invest in a portfolio of about 100. Here's what the average upside is gonna be. Do you want in? Is that what we're talking about here at
I
the
think
investor
so.
level?
I think absolutely that's our plan. The plan is to bring these types of investments to the mainstream.
Yeah, that's so interesting. I love it. And you heard it here first, guys.
Yeah, exactly.
That's awesome. Well, just to get and because again, we could go on for hours. I mean, this is so insightful, and I can't thank you enough for bringing that light.
Thank you.
As far as keeping it real in the lab, or as we like to say, what do you think as a key takeaway is the biggest misconception that people have about this model, that they should just really think twice about having that misconception, just so, remove that mind block, so that they can go deep on this. And then obviously we'll give them information on how they can find out more.
Yeah, it comes back to the question we always get, or the reaction we always get, which is, this is too good to be true. What's the catch?
Yeah.
And again, the answer is, just take a moment to understand how our investors get paid. You'll then see how this is it's a trade. You're house rich and cash poor. We have investors that are cash rich and house poor. They want an investment. So the biggest takeaway from doing this for a number of years really is that it's that misconception that because you don't have a monthly payment, somehow there's a catch. And I think that's what will become disavowed over time as people get more used to these types of instruments.
Absolutely. Okay. Thank you for that. And then now the core rapid fire questions. I have a few of my own that I want to hit you with here. Again, you've done so much. We want to tap into a little bit your resources. You got to be able to give us one of your favorite books that you've read, or anything, a resource that you like to tap into frequently. We'd love to get into the mind of how Matthew Sullivan thinks.
I wouldn't recommend that. It's a very curious place. Not even I would like to go there. But no, I people ask me this a lot, and the one book that always springs to mind is quite a fun book. It's a book by Chris Voss, who's this ex-FBI negotiator. And it's called, Never Split the Difference. Now, the thing is, I met Chris a few times because I used to go to this crowdfunding. God, what's wrong with me? I used to go to this event, this networking event called Metal, which used to meet in Beverly Hills and every Saturday. And Chris was a fairly regular member. So fascinating guy. But it's not just about the book. What he does is he has all of these sort of things on where he talks to people at Google and all these other companies that are recorded on YouTube. And he just brings this sort of fascinating insight about how the FBI get inside your mind, and just by changing certain words and the way that you ask questions. For example,
how am I supposed to do that?
Well, things like when you phone someone up, the natural thing people say is, God, is this a good time? I'm really sorry to bother you. And people say, oh, no, actually it's not. But if you just change that by saying, I'm sorry, Ruben, is this a bad time? Your natural reaction is, no, it's fine. It's fine. Don't worry. It's fine. Carry on. So just by saying, have I caught you at a bad time? Just something like that, which clearly the FBI have spent billions of dollars and thousands of man hours sort of figuring out. So just things like that is really useful stuff.
I love that. One thing I'll tell you, first of all, I love Chris Voss. I got into his very deeply. I've heard him speak multiple times, and I listened to his audiobooks. So I got his voice in the back of my head, like,
yes.
Just, how to strategically use those questions. Another one, I'll leave you guys with a gem. We had a gentleman here, Phil M. Jones. I don't know if you know him, exactly what to say.
That's it. Yeah, I've heard of the book. Yeah.
Powerful stuff. A lot of people like to say, do you have any questions? No, don't say that. What questions do you have?
Yeah.
Like, it's just fascinating, the psychology of it.
Tiny little tweaks like that,
Powerful stuff. Thank you for that, gem. You guys check it out. That's a big book, big time book, and I would highly recommend it as well. Matthew, what's the best habit that serves you every day, you would say?
Apart from enormous amounts of coffee, which I would recommend to everybody. It's actually really good for you, and don't listen to anything the doctors say.
You must own a coffee company, guys. I think he's plugging it.
Well, no, that's right. Yeah, it's my next venture. No, but it's trying to avoid getting up and then sort of stampeding to the inbox. So we've got this sort of long-suffering Labrador who actually likes being taken for a walk every morning. So thankfully, it doesn't rain that much here. So what I try and do is get up and get out of the house and start walking and thinking, and that is remarkably beneficial for a number of different reasons. So that just get out. So rather than just getting up and whilst you're rubbing the sleep out of your eyes trying to read your inbox, just clear your head and set yourself up for the day, and then drink lots of coffee.
Plug to the coffee right there. We'll look out for that venture for sure. But yes, absolutely. Get that blood flow going, guys. Best tool that helps you excel throughout your day. It could be notes, it could be an application, it could be Notepad, Excel.
It's
like,
a book, actually. No,
Yeah.
you know, for those viewers who are watching in black and white, the book here is no, this is my notebook. So I have a notebook when I use a pen and write stuff down and draw pictures when I'm speaking to people. And, you know, it's so analog. And what I do, funnily enough, is I rewrite. So every day I'll write a list of stuff I've got to do. And the next day I spend half the morning copying the stuff over from the previous day that I haven't done. You know, just it's like a penance. Like if you have to write this so many times, you're going to end up doing it just so you don't have to write it on the following day's page. So just and I find that works much better than all of these sort of you know, to-do lists that involve you sort of, you know, pointing your finger at a phone.
I find that so powerful as well. It's so funny you say that. Like as you're speaking, I just write every time.
Yeah.
I'm a writer, and I do the same thing as far as writing things down. A little old school that way. When the Atomic Journal is one of my favorites. It's by I think what's the gentleman's name?
I don't know. It's a great title, though. I wish I'd thought of that.
Yeah. Atomic Habits.
It's either that or it's a very small book, you know, that you need an electron microscope to read.
No, it's the author of Atomic Habits by James Clear. If you've read The Compound Effect by Darren Hardy, then it's like literally the
Oh, I see. Yeah, it's all very chemically based, you know. Yeah.
So, I mean, it's funny. You typically have this question: cash flow versus equity, as a quick fire round question. I'm curious to hear which one.
I think both, honestly, because it's a balance. I mean, you need cash flow to survive, but typically there's always a trade-off. You know, you can get much better returns if you have the added risk of being an equity investor. So it's a balance, isn't it? You know, it's like all of your investments. You don't want to have all of your investments in cash flow because you know you miss out on that long-term appreciation.
If you had one superpower, Matthew, what would you in any of your businesses, which one would you pick and why?
I think the ability to sleep on aircraft. Honestly, it is a superpower. You know, it's the ability to fall asleep within seconds after sitting on an aircraft, no matter what the duration.
Really? So I'm assuming you have trouble sleeping on the aircraft.
No. It's just I don't have to know, but honestly, lots of people do have trouble sleeping on aircraft. But I'm beginning to realize that it is indeed a true superpower, being able to sleep probably anywhere. But I always have trouble answering that question seriously because I feel, you know, that it's for others to judge what my superpower is. I'm very good at cooking scrambled eggs. Actually, I've never had any complaints.
I guess what I was asking, if you had a superpower you wish you had.
Well, yes, lots. Where do I begin? Yes, they're all evil. Believe me. Yes.
Let's go with a new. Again, you have a technology background. What's a application or anything out there that you feel people should double down on and kind of add it into their ecosystem? And I know this could be detrimental because we already have enough stuff going on. But is there anything that you see as a kind of
I just think forward? That it's a lot of it is you know, a lot of, you know, technology is about how you use technology.
Absolutely. Couldn't agree
you
more.
Know, and you can have the most incredible systems, but if you don't use them, and the one thing that has been fantastic for us is just a good functional CRM system. And I know this sounds absolutely, you know, the bleeding obvious, but a CRM system that allows you to keep track of conversations that you've had, and married with your ability to make notes and keep it up to date. So it's that combination of having systems that make it easy for you to automate things as long as you're willing to put the information in the first place. So good CRM, good automated marketing systems allow you to keep in contact with customers, remind them to do things when you will have forgotten to do that, you know, long time ago. But they are entirely dependent on your ability to sort of, you know, it's garbage in, garbage out. So it's always that combination of you being able to, you know, put the information in the first place.
I love that. Is there one that you would recommend?
Oh, we're still trying. We use Salesforce, we use Aptivo, we use Constant Contact. There's lots of different ones, but I think yeah, I mean, one that is we really like, and it, is Aperitivo. It's just that's a good budget, powerful. It's a great one to start with. And we have no interest in Aperitivo, don't we? We don't have shares in it or anything.
No, I mean, we're here to give value all the time. So I'm just curious because I've that's another thing, right? The Asana, the Monday.com. Like there's some names out there, but I'm curious if there was one that you really resonated with, because I know that's one thing where
I think they're all pretty good if you get to use them. I think most of them are pretty flexible. There's all sorts of software where you can integrate one system with another, so you can sort of move data around different systems.
Yeah, no, absolutely. Okay, and fast forward again, we talked about your journey 30 years back, building a lot of different businesses, opportunities, tackling new ventures, looking, whether you're looking at it from an investor's lens, as a business owner, what's one thing you wish you could have told yourself 20 years ago to implement, that today is resonates with you strongly? Is there any advice you would give to your maybe 20-year-old self?
Well, yeah, I think I remember I started, I think I was about 30 something. I started a telecoms company that did really well. We were competing with the incumbent British Telecom. So we started off when the markets opened, a bit like when the CLECs and the ILECs and the telecommunications market opened up in the US. So I started a business, did really well because it was in the early stages, and we were able to compete head on with British Telecom and offer much cheaper prices and better service. But then I sold the business, because it was I was tempted, and it was a bit of an ego boost for someone to come along and say, "Can I buy your business off you?" So, and then it's actually quite difficult to go and find something else that you are really passionate about. So the answer is, if you find something that you're good at, just stick at it and become the subject matter expert, become the best, the biggest in that field. Even though it's tempting to sort of try other things, because if you can continue to grow, I mean, like today, 15, 20 years on, that company now probably would be huge, would be much, much bigger than it would have been. So I would have grown that business and put all my energies in, rather than being tempted by other the new shiny newfangled objects.
I really like that answer. That actually resonates with me very well.
Yes, as we know who we are. Yes.
Yeah. It's like guilty.
Yes.
No, but it's important to hear that as someone who's been ahead, who's had a lot of success, which I appreciate you sharing those gems with us, who
my pleasure, yeah.
who are starting out or have companies in place, and they're thinking there's just so many moving pieces and so many distractions on opportunities. It's good to hear that as well coming from you.
Brilliant.
Yeah. So with that said, look at that. I'm splashing water. It's game time. I already know it's time to just put this one away.
It's gin and tonic time. Yes.
Absolutely. Well, how can the people find out more about you and all that you're doing? And again, if they want to find out more about really how to turn their equity into cash, obviously that was a big topic for us today. Where can we tap in more into your network?
Well, yeah, everything's on the website. So it's Quantum RE. That's QUANTMRE.com. Everything's there. So we've got the calculators, we've got a free downloadable guide that explains how this stuff works. We've got contact details, previous podcasts and videos, and lots of information there. So that's the one place. And we are always delighted to speak to as many people as we can. So if you've got any questions, just ping us an email and we'll get back to you as soon as we can.
Absolutely. So if you're driving, keep your hands on the wheel. We'll have that in the show notes for sure. And we'll make sure that there's going to be multiple snippets of content. You guys know Invested Talent, our company, does a good job of cutting out these clips and putting it out into the universe. So you have no excuse.
I hope they don't do the scrambled eggs one. Yes. The Dr. Evil. Yeah.
Exactly. You saw it. You heard it. Matt here, Matthew Sullivan checking out. And on that note, Ruben, just like that, we are out.